Stable and reliable debt attracts equity capital. It provides takeout financing for construction loans, and it provides refinancing to reinvest to maintain decent and affordable housing. We needed to build the units for the 7 million additional renter households during this decade, and to refinance the $100 billion in loans that will mature over the next 5 years. While most debt comes from private capital, almost half comes from Fannie Mae and Freddie Mac's multifamily programs. The rest comes from FHA, banks, life insurance companies, Wall Street conduits, and credit companies. Congress continues to call for the reform, reduction, and even the elimination of Fannie Mae and Freddie Mac as single-family mortgage providers due to their role in the collapse of the residential home mortgage market. When and how this will take place is a guess. What we do know is that we must be part of the discussion and not find ourselves as collateral damage. Yes, we want to keep things as they are, but because the multifamily programs are part of a larger toxic mortgage system, there is growing support for their restructuring and seeking to create a successor or multiple successors. The government credit through Fannie Mae and Freddie Mac has worked for multifamily, but it's failed the residential home mortgage system. We are asking that whatever reform is passed by Congress, multifamily debt capital continues to flow to all markets nationwide. Specifically, we need to tell members of Congress to preserve and not make changes to Fannie Mae and Freddie Mac's multifamily programs. There is simply no reason to make wholesale changes to their multifamily lines of business. But this being Washington, where politics can sometimes trump facts, we need to be prepared to respond to those policymakers determined to change the current system. After much deliberation, last December, NMHC and NAA released key principles to serve the rental housing needs of owners and residents alike. First, respect the differences between the residential home mortgage finance and placing a mortgage on a multifamily rental property. Everything about the property, borrower, mortgage documents, underwriting process, pricing a loan, primary and secondary markets are different. Preserving liquidity for the multifamily sector requires a solution that is tailored to our unique needs. Second, because private capital alone cannot meet all of the multifamily industry's debt capital needs at all times and in all markets, there is a role for ongoing government credit, both to support the market needs and as a backstop during times of market dislocation. Third, the benefit of any federal credit guarantee should only be available to the investors of the multifamily mortgage-backed securities. It should not apply to the entities issuing the securities as it does today, and they should not be the beneficiary. And as such, we absolutely reject the idea of any future bailouts. Fourth, we support robust taxpayer protections. They should include full compensation to the government for the security-level credit guarantee, appropriate and effective risk-based capital reserves, and an insurance fund that will be an additional level of capital between the mortgage defaults and the taxpayer. All of this would be part of the mortgage interest payment. Finally, the entities succeeding Fannie Mae and Freddie Mac must be guided by a strong and independent regulator. NAA and NMHC crafted a detailed white paper on reform of Fannie Mae and Freddie Mac's multifamily programs, which is available on the websites of both organizations.